Every investor has asked this question at some point. Should I invest in fast-growing companies with sky-high potential, or in solid, undervalued businesses that look cheap today? This debate, growth versus value investing, is as old as the stock market itself. In this video, we'll break down exactly what each strategy means, how they differ, examples of both, and finally how you can decide which approach is right for you. Let's start with growth investing. At its core, this strategy is about identifying companies poised to expand at a rate significantly faster than the general market average. It's a forward-looking approach focused on future potential. These are dynamic businesses aggressively increasing their revenues, boosting earnings, or capturing a larger market share. This rapid expansion is often fueled by innovation or a unique competitive advantage that sets them apart. A key characteristic is their focus on reinvestment. Instead of paying dividends, these companies pour profits back into the business. This capital funds research, development, and marketing, all designed to accelerate their growth even further. Because of this potential, growth stocks often appear expensive. You'll see high price-to-earnings, or PE ratios, because investors are willing to pay a premium today. They're betting that the company's future earnings will be so substantial that today's price will look like a bargain in hindsight. You'll typically find these opportunities in forward-looking sectors like technology, biotechnology, and green energy. Think of Amazon in its early days, evolving from an online bookstore into a global behemoth, or Tesla, which didn't just improve the car, it revolutionized the entire electric vehicle market. The growth investor's mindset is, I'm paying up today because this company could be much bigger tomorrow. This path can be volatile, but as Peter Lynch noted, the key is not getting scared out of a good company. If growth expectations are met, the long-term rewards can be massive. At its heart, value investing is a disciplined strategy focused on finding solid companies currently trading for less than they're truly worth. It's about buying a piece of a business, not just a fluctuating stock ticker. These are stocks that trade at a significant discount to their intrinsic value, a measure of a business's true worth. This disconnect often happens due to short-term market panic, negative news, or simple neglect. Value investors hunt for telltale signs of a bargain, like low price-to-earnings, PE ratios, which suggest you're paying less for each dollar of profit, and low price-to-book PB ratios. They also look for a history of steady, predictable earnings, and often a consistent dividend payment, which are signs of a resilient business. You'll often find these opportunities in more mature industries. Think banking, energy, consumer staples, and industrials. While they might have lower growth expectations, they offer stability and a crucial margin of safety, which helps limit the downside risk. Classic examples are legendary. Think of Warren Buffett buying Coca-Cola in the 1980s after a market crash, or investors scooping up banks after the 2008 financial crisis. The market, gripped by fear, had written them off. But disciplined value investors looked past the noise and saw a rare opportunity to buy great businesses at a discount. The core belief is simple: the market can be irrational. By buying at a discount, they are confident the stock will eventually rise to reflect its true worth. As Benjamin Graham, the father of value investing, famously said, "In the short run the market is a voting machine, but in the long run it is a weighing machine." Let's compare. Growth stocks promise high rewards but also bring higher risk and volatility. Their valuations are built on future perfection, so if expectations fall short, the stock can plummet 50% or more. Value stocks are generally more stable but can underperform in bull markets. The main risk is the value trap, a stock that's cheap for a reason and never recovers. Growth is best for investors with a long-term horizon of 10+ years who can stomach volatility. This time frame is needed to ride out the swings and let the company's vision materialize. Value is better for investors wanting consistent returns, income through dividends, and lower downside risk. The focus is on capital preservation and reliable income from established businesses. Growth returns are driven by aggressive expansion. Companies reinvest profits to scale revenues and market share, aiming for industry dominance instead of paying dividends. Value returns are driven by a re-rating, as the market recognizes a stock's true worth, plus the consistent dividend payments you receive while you wait. Growth outperforms during low interest rates and economic optimism, like the 2010s tech boom. Low rates make future profits more valuable today. Value outperforms during rising interest rates and inflation, or when investors seek safety, like the energy and banking sectors that led in 2022. The growth mindset requires optimism and a belief in innovation, investing in a company's potential to shape the future. The value mindset demands patience and contrarian thinking, buying what's unpopular based on analysis that the market has mispriced it. Think of growth stocks as a rocket ship. The journey is fast and thrilling, but you must be prepared for serious turbulence. And value stocks as a freight train, slower and steadier, but it carries a reliable payload and is much harder to derail. Many investors mix both strategies. Funds like Vanguard's Growth ETF, VUG, or Value ETF, VTV, let you lean one way or the other. Some legendary investors combine them. Buffett started as a pure value investor but later bought growth companies like Apple at a reasonable value. This hybrid is sometimes called GARP investing, growth at a reasonable price. Ask yourself, what's your risk tolerance? Can you handle seeing a stock drop 40% and hold on? Growth might fit. Prefer steady dividends and less drama. Value might be safer. What's your time horizon? Long-term horizon with faith in innovation. Growth. Shorter-term goals or need income. Value. What excites you? Do you love following disruptive tech? Growth investing. Do you enjoy digging into financial statements for bargains? Value investing. Neither strategy is better all the time. Markets are cyclical and leadership shifts. Historically, value dominated for decades, but growth crushed it in the 2010s. In recent years, we've seen swings back and forth. Howard Marks once said, "There are old investors and there are bold investors, but there are no old bold investors." Translation, balance is key. Don't bet everything on one side. To wrap up, growth investing is about the future. Value investing is about the present. One chases opportunity, the other hunts for bargains. The truth is, both can work. It depends on who you are as an investor. The best strategy is the one you can stick with through good times and bad. So whether you choose the rocket ship, the freight train, or a mix of both, consistency and discipline will matter more than labels. If you found this breakdown useful, let me know in the comments. Are you more of a growth investor or a value investor? And don't forget to subscribe because next time we'll be unpacking another big investing debate. Active versus passive investing. Which side should you be on?